Assalamu alaikum friends. So welcome to today's standard. Today's standard is the most important standard, IAS 36, impairment of assets. Okay, definitely you'll be given some non-current asset which might be impaired. Definitely you might be given some intangible assets which might be impaired. Definitely you might be given some. So impairment can come in through anywhere. It could be for your financial asset. It could be your non-current asset. It could be your intangible asset. So this shows that 200% IAS 36 you are going to get. Right? Some standards you can be very sure that you're definitely going to get it. So you need to know impairment of assets. And even in your group accounting, this can be asked. Your goodwill might be impaired. Your asset might be impaired. So impairment of assets could be asked anywhere. It could be asked in more than one place in the single paper. One as an accounting issue, the other one in a group accounting. So let us go through IAS 36. IAS 36, what is impairment? Impairment means when your value is going down. Right, there could be so many reasons for that impairment. Maybe your products have become obsolete, maybe the technology has changed, right? So there are some external factors and internal factors why impairment happens, and we are also looking forward to how to calculate this impairment. And also when we don't know specifically for which asset the impairment is, we allocate it, right? There's a term known for it, cash generating unit. So all these things will be covering here. And this is the first part, and the next part I will be doing questions on impairment of assets. So definition, as I told you, it is the reduction in the recoverable amount. There's a formula to calculate impairment of assets. Impairment is the reduction in the recoverable amount of an asset or a cash generating unit. Okay, because sometimes you cannot specifically say that this is the asset. So we named it as cash generating unit. There we have a group of assets, and then we allocate our impairment among the cash generating unit. Below its carrying amount. So recoverable amount went down below the carrying amount. So it's basically carrying amount minus recoverable amount, that is your impairment. And IAS 36 says that you should carry out, an entity should carry out impairment review at least annually if these two things are there. An intangible asset is not being amortized because it has an indefinite useful life, right? We know an intangible asset has two life. One is indefinite life, one is finite life. If it has finite life, we take amortization, we amortize it, right? Indefinite means where we don't know the useful life. Okay, they don't define what is the useful life. In that case, indefinite, we don't amortize it, but we check it for the impairment annually. You should check it. So an intangible asset is not being amortized. You don't amortize it, but for impairment review, you have to check it if it has an indefinite useful life. Goodwill has arisen on business combination. This is from your group's accounting point of view. When you acquire your subsidiary, you need to calculate goodwill, and sometimes goodwill also impaired. So you need to check for that also, impairment of goodwill. Otherwise, an impairment review is required only when there is an indication that impairment may have occurred. So other than these two conditions, you need to review for impairment only when you can see that there are conditions or there is an indication that impairment has occurred. What are those conditions? One is known as internal factors, the other one are known as external factors. So let us go through that list. Let us go to the external first. Okay, so external are this list. You can just go through this list. Unexpected decrease in the assets market value, significant adverse changes have taken place or are about to take place, technological, market, economic, legal environment, everything is not in your favor. Interest increased, decreased, right? Sorry, increased interest rates have decreased an assets recoverable amount. An entity's net assets are measured at more than its market capitalization. So that means all these factors, whether internal or external, are all against you, right? In the market, the product's value is going down. New technology has come up which makes your product more outdated. Now let us go to the internal sources. Internal sources, something within your organization you can see. These are external. Evidence of obsolescence or damage. Okay, there is or about to be a material reduction in the usage of an asset, or evidence that the economic performance of an asset has been or will be worse than expected. So if this external or internal information is there, you carry out impairment review annually. Otherwise, no need to carry impairment review annually. But if it is these 2 points, goodwill that has arisen on business combination as well as intangible that has an indefinite useful life, then whether this internal or external factors are there or not, you still need to carry for this too. You need to carry a impairment review annually. Now we are calculating an impairment loss. How to calculate an impairment loss? This occurs when the carrying amount of the asset is greater than the recoverable amount. So how to calculate the recoverable amount? Recoverable amount is the, remember this because in the exam you might need to calculate your recoverable amount because before you calculate impairment loss. Okay, recoverable amount is the higher of fair value less cost to sell and value in use. Whichever is higher. If your fair value less cost to sell is higher, then that is your recoverable amount. If your value in use is higher, then that is your recoverable amount. Fair value is defined. So we know what our definition of fair value through IFRS 13. Okay. Now, cost to sell. What about fair? See, we know fair value, but fair value less cost to sell. So what is the cost to sell? This is incremental cost directly attributable to the disposal of an asset. So whenever you have disposed an asset, whatever the costs directly relating to that disposal are known as cost to sell. So you can deduct this from your fair value. What about value in use? What is value in use? So value in use is calculated by estimating future cash inflows and outflows from the use of the asset and its ultimate disposal. So you need to apply a suitable discount. Sometimes remember you might be given a cash flow. That is to find value in use. Sometimes they directly might not say that this is the value in use. You need to find out that value in use by discounting of cash inflows or outflows. Okay. With regards to the estimate of cash flows, IAS 36 says what? If it is estimate of cash flow that you have to use. The cash flow projection should be based on reasonable assumptions and the most recent budgets and forecast. Cash flow projection should be related to the asset's current condition and should exclude expenditure to improve or enhance it. If there are any expenditure which are needed to improve the asset's current condition or enhance it, you don't take that part. That expenditure is excluded. Only in the asset's current condition, you have to take the cash flow. Period in excess of 5 years, management should extrapolate from earlier budgets using a steady declining or zero growth rate. That means more than 5 years are not taken as a good forecast because it's hard to focus more for a long period of time. Management should assess the accuracy of their budgets by investigating the reasons for any differences between forecast and actual cash flows. Okay. Now let us go to the discount rate. Which discount rate should you use? This discount rate you use to obviously to reflect time value of money and the risk specific to the asset for which the future cash flow estimates have not been adjusted. Because you're focusing your future cash inflows and outflows. So to focus future cash inflows and outflows, today you need to find the present value of those future inflows and outflows. So you need a discount rate to discount it. Okay. Now carrying out an impairment test. So you need to compare two things here. Everything is explained in this. You understand this, you understood impairment. You compare the carrying amount and the recoverable amount. Recoverable amount you need to calculate higher of fair value less cost to sell or value in use. Okay. Whichever is highest, that is the recoverable amount. So let's say here the higher amount is fair value less cost to sell. So then here it will be carrying amount minus fair value less cost to sell. Okay, which will be an impairment loss. If fair value less cost to sell is higher than the carrying amount, what happens? That means carrying amount is less, but you're deducting a higher amount. Recoverable amount is high. Then there is no impairment. There is no impairment and no need to calculate value in use. So the point when your fair value less cost to sell is higher than your carrying amount, no need to calculate value in use. And no impairment also is recognized. Okay. Because you cannot recognize negative impairment. Remember that. It should be positive or zero. Recognizing impairment losses. Where do you recognize impairment losses in the financial statements? It is immediately charged in the statement of profit and loss or and other comprehensive income. So it is there in the profit under the expense losses or expenses in the profit and loss account, right? Now, if the asset has previously been revalued, okay, this is their talking about revaluation. What should you do? Previously, it was revalued upwards, okay. The impairment is recognized as a component of other comprehensive income, okay. Why? See, if an asset is revalued upwards, what do we say? The gain goes where? The gain must have recognized in other comprehensive income, right? If it is IAS 16, so same rule we are applying. If it is under other comprehensive income, the fair value gain. So we say that impairment also for that asset goes to other comprehensive income. Okay, that's why it is recognized in other comprehensive income. And it is debited to revaluation reserve because impairment will reduce your revaluation reserve. So your debit to revaluation reserve until the surplus relating to that asset has been reduced to nil. Okay, that means it should be nil at the end. What about the remainder of the impairment loss? It is recognized in it is recognized in profit and loss. Definitely will understand this. Let me explain this through number. Let's say in your revaluation reserve, you currently have 5 million, but your impairment is, let's say, 10 million. That is your impairment. And this was a revalued asset. Your impairment is on a revalued asset. It was previously revalued upwards. So that means it must have been recognized in OCI, right? It was 5 million, the revaluation gain. Now in impairment, it is 10 million impairment. So what do? You debit 5 million in your revaluation reserve. Because in the revaluation reserve, you have 5 million. That means so your revaluation reserve goes off. It's nil now. 5 million minus the impairment 5 million. So what about the remaining 5 million? Remember impairment was 10 million. Now 5 million went in the revaluation reserve. Now you have a remaining 5 million. So that remaining 5 million, that remainder goes to profit and loss. I hope this makes you understand it better. But definitely we'll do questions. The recoverable impaired amount of the asset. What should you do after you impair the asset? You then need to depreciate it or amortize it if it's intangible asset. So depreciate or amortize over its remaining useful life after the impairment. Okay, don't forget that because it's an asset that you are impairing. Now let us go to the cash generating units. So sometimes it is not possible to identify the cash flows relating to particular assets. You cannot say, okay, from this asset I'm getting the cash flow. So they have given one example. One example is a factory production line is made up of many individual machines, right? But the revenues are earned by the production line as a whole. You cannot say that individual machines are earning revenue. When the revenues are earned, it is earned by the production as a whole only. They are considered one single unit together, the whole production line. But even though that production line is made up of many individual machines. So in this case, what should you do? Value in use must be calculated for group of assets. This is like group of assets are combined in one. That is known as cash generating unit rather than individual assets. Okay, so for here, when you need to calculate value in use, you calculate it for group of assets, not just one individual asset. These groups of assets are called cash generating unit. Okay, so cash generating unit is the smallest group of assets that generates independent cash flows. Okay, having that group, you can have cash flows, independent cash flows, smaller group of assets. Now we need to allocate assets to the cash generating unit. How to do that? Because cash generating unit is a group of assets, right? So we need to allocate it the assets to the cash generating unit. CGU, the short form. So the carrying amount of the cash generating unit includes the carrying amount of the assets that can be attributed to the cash generating unit and will generate the future cash inflows used in determining the cash generating unit's value in use. How do you calculate the carrying amount of cash generating unit? It is simply the addition of the sum of all the asset, whatever is there in cash generating unit. And there are two problem areas. What is it? One is goodwill, one is corporate assets. See, corporate assets, assets that are used by several cash generating unit. For example, a head office building or a research center, right? A head office can be used from many businesses. Buildings use head office building or research center. This is used by many departments in the business. So for such assets, they do not generate their own cash inflows. You cannot say research center incurs their own cash inflows, but it is used by other departments to earn revenue, earn cash inflow. They themselves do not generate. The head office building on itself do not generate cash inflows. It is the one who are using that head office building are generating cash inflows. So they do not generate their own cash inflows. So they do not themselves qualify as cash generating unit. So you cannot say this are cash generating unit, head office building or research center. Next is goodwill. Goodwill also, which does not generate cash inflows independently of other assets. So see, goodwill comes with other assets. Okay, and often relates to the whole business. You cannot say goodwill you are using for this asset or this asset and you will earn income from through goodwill. No, you are not earning income through goodwill. It is used in the whole business. It relates to the whole business. Independently, you are not getting any cash flows from that goodwill. Not independently from other assets. Okay, so goodwill also you cannot say it's a cash generating unit. So corporate assets and goodwill should be allocated to cash generating units on a reasonable and a consistent basis. Should be consistent and should be reasonable when you are allocating it. A cash generating unit to which goodwill has been allocated must be tested for impairment annually. What is important is this. A cash generating unit, that means to which goodwill has been allocated. That means goodwill is there in the cash generating unit. That time if goodwill is there, then it needs to be tested for impairment annually. So allocation of an impairment to the unit's asset. Now you are allocating the impairment. So if an impairment loss arises in respect of a cash generating unit, okay, if that impairment is because of cash generating unit, then what should you do? You need to allocate among other assets in the following order. This is the order and you must follow this order. It's always first against goodwill. Remember this, always first against goodwill. Then again other assets but in a pro rata basis. How? In proportion to their carrying amount, whatever the value of that asset. That let's say there are three assets. So whatever their proportion in the to their total carrying amount, that is here. That is the amount you need to allocate for the impairment loss against other assets. But first is always goodwill. When it is cash generating unit, you need to remember this order. However, the carrying amount of the asset cannot be reduced below the highest of. Remember, you cannot reduce the carrying amount to the highest value. That is the maximum value you can reduce. The maximum could be this, or this. What is it? Fair value less cost to sell. Maybe this is the highest. So you can reduce up to this. Fair value less cost to sell if that is the highest. Or value in use. Or nil. So this means it will never become negative. It will always be a positive figure. Zero is the maximum amount. Okay. Zero is it will not go below zero, the carrying amount of asset. You can never reduce it below zero. Let's say fair value less cost to sell is 10. Value in use is 20. And this is nil. So 10, 10, 20, 0. Which one is the highest? 20, value in use. So you should take this to reduce the carrying amount of the asset. More than this, it cannot be reduced. Okay, we'll definitely have an illustration for that. Let us go through this illustration. Impairment allocation within CGU. Capit has identified an impairment loss of 45 million. And for one of its cash generating unit, the carrying amount of the unit's net asset was 150 million. whereas the unit recoverable amount is 109. So there's an impairment, right? Because recoverable amount is less than the carrying amount, and it is 41. Yes, the difference is 41. Now they have given the net asset, how they have broken the 150. Goodwill, property, machinery, vehicles, patents, and net monetary assets. So the net selling price of the unit assets were insignificant except for the property, which had a market value of 35. The net monetary assets will be realized in full. How is the impairment loss allocated to the assets within the cash generating unit? How do you allocate that loss now between goodwill, property, machinery, vehicles, patents, and non monetary assets? So, solution. You see, this is what we know. It's firstly against goodwill only. Okay, so firstly, the impairment loss is allocated to goodwill, reducing its carrying amount to nil. That means goodwill will be reduced to nil. How much is goodwill? 13. So, you deduct 13 fully. The impairment loss cannot be set against the property because it is net selling prices greater than its carrying amount. Can you realize it against property? The next item. They say no because selling price is greater than the carrying amount. You see the carrying amount of the property, it is 20, but market value is 35. That means no impairment has occurred for property. You cannot take impairment for the property because market value is higher than the carrying amount. Now let us go to the machinery. Machinery 49, vehicles 35, patents 14, and net monetary assets 19. Next, so the so likewise, the impairment loss cannot be set against the net monetary asset also. Net monetary asset you cannot set your impairment loss against. Why? Net monetary asset means like your receivable or cash. It's like your current asset. Okay. Why? Because they'll be realized in full. So when they are realized in full, you cannot recover. So only three assets are left: machinery, vehicles, and patent. After the goodwill, of course. So the balance of the impairment loss. What is the balance? Total impairment was 41. Out of that, for goodwill, you have allocated 13. So balance 28. This is apportioned between the remaining assets in proportion to their carrying amount. So for example, the impairment allocated to the machinery. So what is now, if you see, you need to add the carrying amount of this three. 49 plus 35 plus 14. Let me calculate it. It is 98. Okay. So if you see, it will be allocated. So the total amount, this is 98. Okay. The total carrying amount. Out of that, for machinery, how much? Machinery is only 49 out over 98. They are carrying amount. So it will be 49 over 98 into 28 because this is the remaining impairment. So for machinery 14 million will go. The table below shows how the impairment will be allocated. So that is for machinery. Likewise you have to do for the other two also, vehicle and patent. So if you see, this is before, then this is the impairment loss. Okay. So once you take 13 fully, you can take for goodwill. You have to apportion only for the other assets, not for goodwill. Goodwill you always take full. So machinery 14, not fully. You see, you're not taking fully. You are proportioning it. Then from patent this one. But from property and net monetary assets, you cannot take the impairment loss. After you add, this is the revised amount. You see, and total 40. It should be like this only. At the end, you should get this amount only, and at the end, the revised value should be this amount only. Now, another example. Impairment if reasonable allocation is impossible. So if no reasonable allocation of corporate assets or goodwill is possible, then a group of cash generating unit must be tested for impairment. You test the group of cash generating unit. If you cannot reasonably allocate, then you must, this is tested for impairment together in two-stage process. Okay, so we'll go through this example to know the two stages. An entity acquires a business comprising three cash generating units D, E, F, but there is no reasonable way of allocating goodwill to them. After 3 years, the carrying amount and the recoverable amount of net assets in cash generating units and the purchase goodwills are as follows. Now, how are you going to do it in two stages? Step 1. You need to review the individual units for impairment. It's always this, okay? First, individual units you need to review. F is in, so if, let's see. individual units means just see which one where the recoverable amount is less. So if you see D is not impaired because recoverable amount is more. If you see E is also not impaired because the recoverable amount is more. F is impaired because recoverable amount is less than carrying amount. So F is impaired. A loss of how much? The balance 420 minus 360, 60,000. This is recognized and his carrying amount is reduced to 360,000. That means recoverable amount is 360. So it needs to be reduced to 360,000 only, the carrying amount. Okay. Step 2. Compare the carrying amount of the business as a whole, including the goodwill, with its recoverable amount. This is step 2. What is the total carrying amount of the business? It is now this. How? 1170 minus 60, because 60 is an impairment. Okay, so this is the carrying amount. You see, with the goodwill also you have to take. So you are taking all this three, the carrying amount and with the goodwill. This is the amount. From 1170, you are minusing 60,000, the goodwill for F. Okay, so this is now the total carrying amount of the business. A further impairment loss of 30,000 must then be recognized in respect of the goodwill. Why is it so? If you see that from this amount, okay, this carrying amount 110, you need to deduct this 108. This amount you need to deduct. From this one. So that means there's a further impairment loss of 30,000 that must be recognized in respect of the goodwill. Now the goodwill has been impaired. Okay. Because the recoverable amount is less if you see the total than the carrying amount. Okay. Or there is another way of doing this, which is much easier. Just compare these two methods. Just minus 1080 from 1170. It will give you 90. So out of 90, 60 is only for this F impairment. So minus 60. You are left with 30. That means goodwill has impaired with the 30. Okay. Now let us go to the reversal of an impairment loss. What should you do when you have to reverse that impairment loss? Okay, just give time. We have the disclosure left. Okay, so we only have the disclosure left after the reversal part. After that, we'll be moving on to questions. The calculation of impairment losses is based on predictions of what may happen in the future, right? Sometimes actual events turn out to be better than predicted. If this happens, the recoverable amount is recalculated and the previous write down is reversed. So just see, today you are predicting that after 3 years your value of the asset will go down. It's just a prediction. But after 3 years, so today you have recognized an impairment loss. Let's say after 3 years, your value of an asset actually it went up. Conditions improved, it didn't go down. So now that impairment loss, that 3 years before you have recognized it, now you need to write it down. It's reversed now because there's no impairment loss now. Conditions improved. So recoverable amount you again need to recalculate after 3 years. Okay. So impaired asset should be reviewed at each reporting date to see whether there are indications that impairment has reversed. See, sometimes impairment reverses. Conditions actually improves after a year or 2 years. So always you have to see for that whether the conditions are improving or not. If conditions are improving, you reverse it. If it's not, then keep on. That impairment will be there. Assets will be impairing every reporting date. So you need to review. Once an asset has been impaired, you need to review it every year to see that it has been reversed or not. A reversal of an impairment loss is recognized immediately as an income. Isn't it an income? Because impairment is a loss. Impairment loss. It's an expense. But once you reverse it, it's an income now. So it will be recognized immediately as an income in the profit and loss, a reversal. Okay, if the original impairment was charged against the revaluation surplus, because sometimes that impairment is based on a revalued asset. Okay, so if that is the case, original impairment, it is recognized, then that gain will go to other comprehensive income. So it depends on whether that impairment is on a revalued asset or not, and credited to revaluation reserve. It will be credited because your revaluation reserve will go up. It's an income now. Reversal must not take the value of the asset above the amount. The reversal must not take the value of the asset above the amount it would have been if the original impairment had never been recorded. You cannot increase it so much. If the original impairment was not there, whatever the value of the asset must have been then, that amount only you have to take when you reverse it, not above that. So the depreciation that would have been charged in the meantime must be taken into account. Remember, depreciation you didn't take because it was an impairment loss. But value of an asset went up, in fact. So because of value of an asset went up, depreciation you didn't calculate. Now you need to calculate that depreciation. The depreciation charge for the future period should be revised to reflect the changed carrying amount. You need to change, it should be revised because carrying amount changes to reflect that carrying amount has been changed. So this things, how do you learn this thing? There are so many points. See, it's not about memorizing points. Just read it once or twice or thrice. Okay. And you just need to keep these points when you're doing calculations, when you're doing a question on it. That should it be recognized? Should it not be recognized? Is it a revalued asset? Is it not a revalued asset? I didn't recognize it, so now I need to recognize it and also recognize depreciation. All these things you need to think when you're doing calculations. That's why we need all these things. You, as it is, you don't have to memorize these points. You don't have to write all these points. Okay. But when you're writing and when you're told to explain, explanation is not too big. Very briefly, you just have to explain that because under this standard, this is applicable. So you do like you go by this way. Because this is a revalued asset impairment, that's why you write it in other comprehensive income. So this is just a one or two line reasons you need to give. SBR will never ask you to write all these points. So there is no use of memorizing this whole list and wasting time. You just read it once or twice or thrice. This is the way how to remember. Many people, students ask me how to remember, ma'am. I study so hard, but I forget. Well, if you're studying so hard, you're only studying hard only. Studying is not to be something that you're studying so hard. That means you're not understanding the concept enough. That's why you're taking so much of time. You need to understand first. And don't think too much about forgetting things. I'm forgetting. See, ultimately, if you do questions, that's why I always tell do more questions. Then you actually go to the textbook. Because once you do the questions, then you are actually using your brain to think, okay, this is how it goes. Okay, this standard I need to recognize. Okay, this is how I recognize under the standard. Without doing questions, you keep on memorizing the points from your textbook, it will not work. Because we always remember more through application. When you do a question and you go wrong in a question, trust me, you will never forget that incident. You will always keep on thinking what went wrong, why it went wrong. You will learn much faster. But when you're going through a textbook, that is called passive learning. You're actually not learning. You're not practicing what you're learning. You're just reading. You're reading. And reading once is not enough to retain information. At least 2 or 3 times you need to read any piece of information when you're reading. I recommend to read 2 times the textbook if you want to read and remember things, because that's what I did. I always do it. At least 2 or 3 times I'll be reading textbook, not to memorize, just to keep fresh with all the styles. I remember the points because at least in the theory I have to write something, right? So I never memorize points. It's just some rules, calculations that I need to memorize, like formulas and all. Yes, there are no things you need to memorize, but calculations and all I never memorize and go. So I don't encourage you to memorize calculations. Once you understand those things, the concept, you will automatically know what needs to be added, what needs to be deducted, and when to be recognized, when to be measured, how to be measured. You will know these things. It's just a matter of practice. That's it. and also the confidence that I can do it. I went through the standard, now I can do it. Like that. Okay. So because see, no matter however roads you know, how well you know all the directions and all, if unless you don't sit in the driver's seat and start driving, you will never learn driving. So the same for this. Unless you go to that the past papers and start doing questions on your own without checking the answer, you will never learn. You will never understand whether you've understood it or not. Because when you go through the textbook, you feel like you know everything, and now I will never forget. I will remember it. It feels like that. Okay. So now let us go here. An impairment loss recognized for goodwill cannot be reversed in a subsequent period. This you need to remember. Because if they ask, right, they will not ask you directly. They will twist and turn, and then they will ask you indirectly. If that impairment loss is for goodwill, and you saw that the condition for goodwill increased, actually, okay, you thought that there was an impairment of goodwill, but actually it was not. But then you cannot recognize it's not reversed for goodwill only. This is the condition. Okay, if it's goodwill, it is not reversed in the subsequent period. That impairment loss will be there. That you reverse the good impairment loss later years for other assets, not for goodwill. So now finally we come to the disclosure. Before I officially I'm done with IAS 36. Before I start doing questions, disclosure is left. So disclose the following. Impairment losses recognized during the period. Impairment reversal also recognized during the period for each material loss or reversal. The amount of loss or reversal and the events causing it. Also the event you need to write, okay? You might write that because of technology, because so many things are there, right? The demand for the product went down. So the recoverable amount of the asset or cash generating unit. It might be of the asset or the recoverable amount of a cash generating unit. You need to disclose. The discount rate use also, because remember for value in use, you need to discount it. The level of the fair value hierarchy used in determining fair value less cost of sale. You need to determine fair value for to find impairment, because fair value less cost to sell or value in use. So to determine that fair value, we have three levels. Okay. I don't know whether you have went through IFRS 13 or not. Definitely my SBR students know this. If you have went through the fair value IFRS 13, level 1, level 2, level 3. Okay. So which level are you using to determine the fair value? That you need to write. So definitely I'm not explaining in detail what is level 1, level 2, level 3. Please go to my IFRS 13 video and check out what are the three levels. You need to know it, because fair value is also a standard which can be asked under any other standard, because fair value is used in many standards. So yes, same like impairment. So that's it. We have successfully completed IAS 36. Now we'll be doing the questions, the test your understanding. So let's start. Test your understanding 6. On 31st December 2001, an entity noticed that one of his items of plant and machinery is often left idle. On this date, an asset had a carrying amount. So this is the carrying amount 500,000, and this is the fair value, and this is the cost to sell. Asset was not sold, and entity estimates that it would generate cash inflows of 200,000 in each of the next 2 years. So the reason why they have given is for you to find value in use. Assume that the cash flow occurs at the end of each year. The discount rate is 10%. Discuss the accounting treatment of the above. And part B, how the answer in A would be different if there was a balance of 10,000 in other components of equity relating to the prior revaluation of the specific asset. So let us go by first A. Value in use we need to find out, because remember when it comes to impairment loss, we need to find the higher of fair value minus cost to sell and value in use. So fair value minus cost to sell is 325,000 minus 25,000, which is 300,000. And this 200,000, so 200, and we discount it for 10, and when you find the present value, this is 347,000. That means this is less, so our recoverable amount will be the fair value minus cost to sell. Okay, because this is a value in use will be our recoverable amount, because this is 300,000. We need recoverable amount higher of, so 340,000, 47,000 will be our recoverable amount. Now the carrying amount is 500,000. this exists the recoverable amount, therefore there's an impairment. The asset is impaired. Okay, so this is the R impairment 153,000, and this will be charged debit because impairment is an expense, and credit profit PPE. From your PPE, because of the impairment, the value will go down. Now coming to part B, imagine it was revalued. So this 143,000 you cannot entirely write it in profit and loss account. Some will go to other comprehensive income. 10,000 was in the other comprehensive income. So 10,000 will be in OCI. The remaining 143 will go to PPE. Sorry, profit and loss. So this is 143, and you need to debit other comprehensive income 10,000. That means there will be nothing in the other comprehensive income. It will be nil, and credit 153. From property, plant and equipment, the whole amount of impairment you need to deduct. So now let us go to just okay. Test understanding 7. This is about cash generating unit. You need to identify the cash generating unit here. A, B, C. So entity has a 3 stages of production. A, they grow and they're growing and felling trees. B, creating parts of wooden furniture. C, assembling the parts in from B into finished goods. Output of A is timber and partly transferred to B and partly sold in an external market. If A did not exist, B could buy timber from the market. The output of B has no external market and is transferred to C at the internal transfer price. C sells the finished product in an external market. And the sales revenue achieved by C is not affected by the fact that the 3 stages of production are all performed by the entity. Okay, so how are we going to identify? A forms a cash generating unit, and the cash inflow should be based on the market price of its output. B and C together they form one cash generating unit because there is no market available for the output of B. In calculating cash outflows of cash generating unit B and C, B plus C, the timber received by B from A should be priced by reference to the market, not any internal transfer price. So definitely this type of questions will not be asked in the exam. What you will be asked is how to allocate the impairment in among your cash generating unit. Okay. 3. There was an explosion in a factory. The carrying amount of its assets was as follows. Factory operates as a cash operating unit. Impairment review reveals a net selling price of 1.2 million for the factory, and value in use is this one. Okay, 1.95. Half of the machines have been blown to pieces, but other half can be sold at least at their carrying amount. The patents have been superseded and now considered worthless. It's now considered worthless. Discuss with calculation how impairment loss will be accounted for. Remember, you cannot allocate impairment against every asset. Each and every asset. Sometimes you cannot allocate. Maybe they have not been impaired. Okay, so we need to see. And first we always start with goodwill. So goodwill is 100, and what is our impairment? Now, the patents. So we'll start with the patents. Okay, they have been superseded and are recoverable amount. So and have a recoverable amount of nil because they are not worth anything. That means their recoverable amount is nil. So they therefore should be written down to nil, and an impairment loss of 200,000 must be charged to profit and loss. Recoverable amount is nil means carrying amount minus 0 is 0. What is the carrying amount of the patent? 200,000. That means you need to write it down by 200,000. Half of the machine have been blown to pieces. Therefore, half of the carrying amount of the machine should be written down only. An impairment loss of 150,000 will be charged to profit and loss. What is the value of the machinery? It's 300, half of it only. And the recoverable amount of the other assets cannot be determined, so therefore they must be tested for impairment as part of the cash generating unit. For patents and machines, you can clearly identify that this is the impairment loss, but not for the other assets. You need to, because they are part of a cash generating unit. When you need to find the recoverable amount of the other assets, you need to find the recoverable amount and the carrying amount of the CGU. So what is the total carrying amount of the CGU after the impairment of the patent and the machine? This one. Okay, see working below. And the recoverable amount is this one. A further impairment of 300,000 is therefore required. Okay. So definitely we know that firstly it will be allocated against goodwill and then other assets on a pro rata basis. No further impairment should be allocated to the machines as this has already been written down to a recoverable amount. You cannot write any further impairment against the machine, okay, because it has already been written down to the recoverable amount. So now they will show you, right? This is what in the exam you're supposed to do from this point onwards, how you allocate. So goodwill we totally will allocate. It will be nil. Patents, it's not worth anything, so nil. Buildings, machines, you cannot do any impairment. It has already been done. For computers and building, pro rata basis. Okay, how did you get 50 and 150? Pro rata basis. 500 over 500 over 2000, because addition of this two into the impairment. The remaining, the how many impairment is remaining? How much ever? So if you see here, okay, this is 2600, the carrying amount. What of the impairment? The higher of this to 1.2 or 1.95. So it's the value in use which is higher, 1.95. So you deduct 1.95 by the carrying amount, 650. So total impairment has to be 650. You see? So here, because this is the opening, okay, this is the revised 1955, because it is the value in use 1.95 million that you have to take. That is the higher of this, higher than the fair value less cost to sell. Okay. So if you take the total impairment charge to profit and losses, 650. Because 2 million for patent, 150 for machine, and now this 300,000 only for computer, building and goodwill. Okay. Now the fourth one. Boxer purchased a non-current asset on 1st of January 2001 at a cost of 30,000. At that date, asset had estimated useful life of 10 years. Boxer does not revalue this type of asset but accounts for it on a basis of depreciated historical cost. At 31st December 2002, that means after 2 years, they were subject to impairment review and had a recoverable amount of 16,000. At 31st December 2005, circumstances which caused the original impairment to be recognized have reversed and are no longer applicable. With the result, the recoverable amount is now 40,000. That means the recoverable amount is now more than the cost. So now how do you do this? The impact of the statements of the two impairment reviews. Now you need to reverse. Okay. So for 31st December 2002, we recognize an impairment loss. Okay, the assets carrying amount 30,000 into 8 over 10. Because after depreciation, okay, depreciation, it was held for 10 years and it started on 1st of January 2001. So on 31st December 2002, 2 years depreciation you need to deduct. So after depreciation, it will be 8 over 10 into 30,000. And recoverable amount is 16,000, so impairment loss is 8,000. The asset is written down to 16,000 and loss of 8,000 is charged to profit and loss. Depreciation in future periods will be this 2,000. Because on the 16,000, you need to calculate depreciation in the future because it is brought down to the recoverable amount. Okay, so when you calculate depreciation in the future period, it will be on 16,000. Divide by 8 because from 31st December 2002, okay, until 31st December 2005, the remaining useful life, it's not 10 years anymore. 10 minus 2, so that's why 1 over 8. It will be 8 years on 31st December 2002. Okay, now what about year end 31st December 2005? When is it reversed? So it's 5 over 8 because 3 years went by from 31st December 2002 to 31st December 2005. So 5 over 8 into 16,000. That means 3 years depreciation you need to deduct from the 16,000 and you will be getting 10,000. Then recoverable amount is now 40,000, so there's no impairment loss. Okay. Now how do you need to work this out? So because there's no impairment loss, that means completely you have to reverse the first impairment loss. Okay, to what? To the carrying amount at 31st December 2005. If there has never been an early impairment loss, so what is the amount? So the year 5 depreciated historical cost. So originally the depreciation was over 10 years. For how many years depreciation you need to deduct? 5 years, starting from 2001 to 2005, 2001, 2002, 2003, 2004, 2005, and on 30,000 because this is the cost. Don't take the recoverable amount 16,000. No, you have to take 30,000. That was the original cost. This cost. If there were no impairment loss have taken place. So this was the depreciated historical cost, 15,000. Now, from this 15,000, the historical, what is the carrying amount? And what is the reversal of the loss? How much you need to reverse? Carrying amount is 10,000. You see, how is it 10,000? Because assets recovered amount is 10,000. Sorry, assets carrying amount on 31st December 2005 is 10,000. So carrying amount is 10,000. And depreciation historical cost is 15,000. So it's 5,000 you need to reverse. The difference between these two. The reversal of the loss is now recognized. The asset will be increased by 5,000. And again, a 5,000 will be recognized in profit and loss. It should be noted that whole 8,000 original impairment cannot be reversed. You see, the whole 8,000 you cannot reverse. Original impairment was 8,000 when you go up and see here. But only out of 5,000 you reversed. The impairment can only be reversed to a maximum amount of a depreciated historical cost based upon the original cost and the estimated useful life of the asset. More than that you cannot. What about 5? That is the last question. CGUs and impairment reversals. Okay, on 31st December 2002, an impairment review was conducted on a cash generating unit, and the results were as follows. So you have two assets. Sorry, goodwill, property, plant, and equipment. Before impairment, and after impairment. The PPE was purchased for 400,000 and 1st of Jan. Useful life was 8 years. At 31st December 2003, circumstances which caused the original impairment have reversed and no longer applicable. The recoverable amount of the cash generating unit is now 420,000. So this is the same reversal, impairment reversal, but with a cash generating unit. That was for a particular asset, the previous one. So now, you see goodwill impairment, you cannot reverse it. But impairment of this one can be reversed. However, this is limited, but when you reverse it, this is limited to the carrying amount of the asset if no impairment loss has been previously recognized. So the carrying amount of the PP as at 31st December 2003, what is it? 150,000 because 180 into 5 over 6. How? What is the carrying amount of PPE that time? 180,000. Okay, into 5 over 6. Because 1st of Jan 2001, it was 8 years. But this was recorded on 31st December 2002. That means 2 years went by. So remaining useful life is 6 years, right? 5 over 6 years. That means on 31st December 2003, 1 year's depreciation is need to deduct. So after depreciation, it will be 5 over 6. 5 over 6 into 180,000. This will be the carrying amount. Okay. If they have not been impaired, then its value 31st December 2003 will be this much. It will be divided by 8, the original useful life, and into 5 because 3 years depreciation starting from 2001 will be deducting. So 5 over 8 into 400,000. If you have not impaired, it will be this amount only. Okay. Goodwill also you have to take. Without only the reversal will not happen, but originally when you are not impaired, you have to take 425 over it. So this would be this 250,000. Therefore, the carrying amount of the PP, so it was 250 and this is 150. So the carrying amount of the PP can be increased from 150 to 250. You can increase the carrying amount of that one. This will give rise to a gain of, if you see the difference is 100,000. So this is, that means there's a gain of 100,000 in profit or loss. Okay, you definitely need to do more and more questions in IAS 36 area. So that with that I have finished IAS 36 and we'll see you in the next standard.